Diane Donnelly. I am with the Donnelly Group of Keller Williams Flagship of Maryland. And I wanted to thank you for tuning in to Facts Not Fears, a series to provide you with the right information at the right time, allowing you to make informed decisions and to help you to avoid making emotional decisions. This pandemic has created some devastating life-changing events. A couple of stats for you. 22 million people are out of work since March. 3.5 million people have applied for forbearances. On March 2nd, a quarter of all loans were in forbearance, and according to the Mortgage Bankers Association, it's now 5.95. I said a quarter, I meant 0.25%, and now it's 5.95. Last week, we talked about ways to stay in your home. We talked about loan modifications. We talked about short sales. We talked about, we touched on foreclosures. Loan modifications. So our goal, as I am in real estate, and our goal is to keep you in your home. But we also know that there are going to be foreclosures, and with foreclosures, there are opportunities for investors to invest in homes. So today's call is for real estate investors or those who are just trying to build wealth through real estate. And today we are going to be speaking with Rick Rawl. He is the Director of Sales and Marketing for Navigator Private Capital, and Tim Board, who is the Director of Operations. So Rick and Tim, welcome to the call, and tell us a little bit about you and what your company does. Rick, why don't we start with you?
Sure. Well, a little history, Tim and I. Well, first and foremost, thank you very much for this opportunity.
Sure.
We appreciate it. Full disclosure, we've worked with Diane and her team on a lot of occasions. You do a great job, and that's not just fluff. So, and you are a little familiar with what we do, but let's give you a background. So Tim and I have known each other for probably longer than we care to admit, probably close to 30 years. We both started in the finance company and lending business. I owned a traditional mortgage company for 14 years, and also a licensed real estate broker, and past president of the board of realtors for Anne Arundel. Tim, I'll let him talk about him, but very similar in a lot of background detailed stuff. And after the crash, as Tim will always say, he stole this. I hate this because he got it right, which is we've seen this movie before. It's just different actors. So, we survived, 08, 09, 2010. I believe he was out of a business. I got out in 2010. I was not having any fun. And then if you recall the term, we were bouncing on the bottom for quite some time. And Tim and I, we're all trying to reinvent the wheel. And we had talked many a time because we realized there was a gap in what traditional lenders offer, FHA, VA, Fannie, Freddie, and an investment vehicle that would allow people to get in, do what they wanted, and get out without the cumbersome regulations of the government. All that good intention, well-intentioned stuff that really led to a lot of frustration. So we were able to gather money, raise it privately, and then our main goal is to be able to put a product out there that allows our clients who have a dream of going into a neighborhood, it can be blighted, doesn't have to be blighted, and a dream of going in and putting a nice quality finished product out there, which is a home. Condos, condos, single families, multifamilies, duplexes, whatever it may be, and sell it for a nice profit. And ultimately, we get the chance to put a family in a house, one quality renovated home at a time. It's asset-based lending, meaning that we're not so concerned with a person's income, paychecks, things of that nature. We are concerned with their experience, especially now, and we'll get into that. And their ability to get in, get the project done, complete it within a time frame, and sell it. And that's a lot of what we do up front to determine with the realtor and our appraisers what the property is going to be worth in the end so they can get in and make a profit. So hopefully that wasn't too long-winded.
Not at all. Thank you for the intro. And Tim, fill in the gaps.
Can you hear me?
Yes.
Yeah. So Rick covered most of it. I would just say like you said, 30 years, seen a lot. I tell everybody when they ask us who we are, I'm an old subprime guy. So started subprime, and in the beginning, when I was young, many years ago, always we were taught make loans, you got to give people an exit. How do you do that? Their exit is always equity. They have equity, they get in trouble, they can get out of the loan. Here I am, old man now, long time. It's still the same thing. That's the principle that we go by. You have equity in that house, you can exit and get out of whatever situation that you're currently in. So that's all I have to add. I mean,
I think that sounds like a sound investment, right? You know, you buy something, you want to have some money inside of the deal in order to make profit.
that's correct. I mean, that's, like I said, that's one of the first things I learned when I started back in the early 90s, doing this. Is, you know, you look at the credit, that's a snapshot. You look at the employment, even, that's a snapshot. They have equity in the property. That's what they can hold on to. And then if it comes down to it, they can sell it. With no equity, what we saw in 08 and 09, again, being part of that, we started making these loans at 100%, using up all the equity, putting them in position that when the economy turned, they couldn't get out. And there was a flood of foreclosure. Just like Rick says, though, it does create opportunity for investors. Every market, no matter what's going on, there's always opportunity for somebody. Somebody, even in this, we know there are people making money hand over fist, in this type of environment.
Right. Oh, so you are exercising your right for our happy hour, Rick.
I don't have to drive. So, unless I get pulled over on my riding lawnmower.
So tell me, Tim, what is the difference between a bank and private money, which is what you and Rick offer?
Okay. I mean, so there's a number of differences. I mean, starting obviously, the bank is regulated, either at the state level, federal level, both. And typically, a bank, they're either lending off of their balance sheet, so they're taking in deposits and they're making loans, depending on whether it's a credit union, so neighborhood bank, or one of the big banks like Wells Fargo or Bank of America. So they are highly regulated, and they will make loans based on, depending on where those loans are being positioned. It's either a loan committee, or like the bigger banks and even some of the mid-sized banks, they underwrite to what they would call conforming or government guidelines. And they're making those loans, and then they're selling them into mortgage-backed security pools that are either like Fannie Mae, Freddie Mac, Ginnie Mae, which are government loans. With us, we have, like I think Rick touched on it, we raise private capital, and we do deal with institutional investors that invest into the loans that we make. But we have more flexibility, again, in what we're lending, and the decisions we make. We can make a loan that makes sense, based on, if everything doesn't fit into a box, we can still get that project financed and on its way. Is that?
Yeah. So as opposed to when you go to a bank and they say, here are your criteria, and they're using who they're going to sell that loan to as what the guidelines are. You guys have more flexibility to say, okay, this extends beyond what a bank might do, but the compensating factors or the amount of equity in that deal will allow me to stretch what the guidelines are. Is that right?
That's right. I mean, that's, it's more of our experience, and that we have guidelines. I don't want people to think that we don't underwrite the guidelines, but those guidelines are based on what we understand that makes someone successful for getting one. Because the last thing we want to do is just give somebody a loan and put them in a situation where we know they're not going to be successful.
Mm-hmm.
So our guidelines are designed around having the success of the borrower in mind. If you can't meet these criteria, the criteria that we set forth, is probably not a deal you should do. That's the way we approach it. So it's different. It's a different mindset. There's still mortgages. So if somebody buys an owner-occupied house, that's a mortgage. What we do is a mortgage, but they're diametrically opposed in the approach, I would say. So our guidelines are based around creating a successful environment for the investor.
So your ultimate goal, you would say, is to help investors make deals that are going to work, that make sense, that they're going to, at the end of the day, you guys are going to close them, and they're going to be able to sell it, and then you guys will be able to keep them going so that your investors are profitable and you continue to do business with them in the future to build relationship for success, for a profitable business for an investor, right?
You said that much better than what I was trying to say, so thank you.
Yeah. Good teamwork, Tim. Do you work with investors who want to buy and hold?
Yes. Yeah, quite a bit. And that market has changed a little. It's actually gone a little bit more towards that recently. And I think, kind of akin after the last crash, unfortunately, because of the hardships that are coming in, it's not going to be immediate, but there is going to be more properties that are going to fall into that group that are getting foreclosed on or people lose. I mean, not only just the financial hardships, but the relationship hardships of living through this, and people just may, life happens and walk away, and that will lead to more inventory. And, one of the key components that I would say here is, we're not hard money. And I think you just surmised what Tim had said. We're not in the loan to own business. We thought long and hard when we were developing our business model and what we wanted to do. And that was just about provide affordable capital that didn't fit into, the conforming box, but so that there was always an exit strategy and they were always going to make a profit. We are not in the loan to own business. We don't have egregious terms. We've never had an adjustable rate. We've never had a prepayment penalty. And again, if you're not going to make money on it, why would we lend it to you? Where some of the other places that, and we'll get into this, it's changed, the marketplace has changed. Thankfully, a lot of those people are out of the market now because they just have lost funding. And fortunately, we still are doing okay.
What is the difference? I'm going to ask you, you said you're not a hard money lender. I think some people on the call may or may not know what a hard money lender is and what the difference is between a hard money lender and someone who gives private money.
Great question. I would say the one combining factor is I don't have to think like Bank of America, and neither does a hard money lender. I don't have to think like Wells Fargo or Primary Residential, which offer, good products. The difference between us and hard money lenders is we are concerned about your profitability, and we want to make sure that you're going to turn a profit. Whereas there's a lot of hard money lenders which are not necessarily concerned. I don't want to throw everyone in that book. There are some others that we compete with that we cooperate with that do good business, but a lot of them really don't care. Just because there are, we treat everybody as a professional, as an adult, whereas in the residential side, for like primary residences, there's a lot of government regulations, and you have to advise people of things. In the commercial world, look, you either know what you're doing or you don't. You're either going to turn a profit or you don't. And in that case, where you have somebody who watched HGTV and is now a professional investor and flipper, they're going to lose their ass, frankly. And a hard money person would be more akin to say, sure, I'll lend you the money, where we would say, there's just not enough profit in this deal for it to make sense for you to take all this time to spend 6, 8, 9, 10 months to come out and maybe make $7,000. Why would you do that? We're looking for our borrowers to make somewhere, in the 25 to 35% range in profitability, give or take. And that's aggressive. Sometimes they make a little bit less, but it's also scalable. In other words, smaller projects for a $200,000 house, if you made 25%, hey, that's not bad. But if you cut that down to 15%, it's like, yeah, that's a lot of time for 30 grand for 9 months worth of my work. Whereas if you go to $1 million property and you made a 15% profit, it's still 300 grand. Mm-hmm. So you have to think of which lane you're in and how we're lending it. And we still have guidelines that we're following, but that's the big difference, is that not only are Tim and I well-versed in this side of the market, our main concern is the takeout product, meaning when you, the realtor, are trying to sell the property, you need to make sure that there's enough to pay, that you're going to get enough to, sell the house, which means for you, a sale, a commission. And you also help put a family in a house. and the seller makes a nice profit. And the hard money individuals aren't necessarily so concerned with that.
So
The
bottom line for the hard money lender is they are just in it for themselves to make a buck by lending the money. Is that right?
I would say yes, but there are some who call themselves hard money lenders in this area that do a fair job. I would say we really differentiate ourselves because we're always, our main focus is, are you going to make money? Is it going to be profitable? If it's going to be profitable, we're your guys and we can think outside of the box. If it's not going to be profitable, again, let's move on to another deal and find something else that will.
You know, and I appreciate that because there are going to be people on the call today or people that are listening to the call in the future that may want to start doing some investing, real estate investing. And what I appreciate, Rick, is when I'm on the other side of the wall from you and listening to you talk and educate people, newer investors for the most part, and saying this deal doesn't make sense, here's why. Let me help. So in essence, let me protect you from this investment that you think you're going to make some money on, but what you haven't considered is X, 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 and X. So one of the things that you do is an appraisal to see what the after repair value is. So if you would, an investor comes to you and says, all right, it's my first time, I've never done this. Tell me the process. What is your process from the investor thinking they found a property that may make some money on it when they go to sell it? They bring it to you. Just walk us through the process of what that would look like.
Sure. So let's say, let's start out first with, I would say the focus of this call is for the investor and for the realtor. So as the investor, one, they want to know what affordability is going to be. So our website is 24/7 like everyone else is. What we'd ask is they sign up, it's free. And then they can, start receiving information about what we do. They can find out all our products online, but they can do one or two things. If they haven't found a property yet, they would load up they would just put in it for a pre-approval. And the pre-approval would be, sample, 123 Sample Street, Main Street, whatever it is. And we would contact them, make sure that because another key distinction between what we do and say Bank of America or Primary, whomever, is we will never lend to an individual themselves. We will only lend to an entity. So because we only do commercial loans. So we would contact them, make sure that they have an LLC or a corporation in place. If they don't have one, we can get one set up with them, refer them to an attorney. Costs us between $200 or $300, and that includes the filing and the operating agreement, which is essential that they do. And then from there, we would say, okay, well, what are you looking for? They'd say, well, I want to buy and flip a house. Well, that's probably right now in today's marketplace, we would say, you're going to need, we're glad to talk to you, but you need some more experience. The experienced investor would say, well, I'm looking in this marketplace. My price point is $200,000 and I have $50,000 or $60,000 to work with. There is our questions. How much operating capital do you have? And what is your time frame to purchase? Do you have a realtor? And then we'd say, okay, we're ready to go. So we want to put you in contact with a realtor, or do you have a realtor? And then what we would do is figure out the area, and then we would start referring them. We actually do a good bit of business that way of saying, I want to be in Pasadena, I want to be in Silver Spring, because real estate is local, and you want to make sure that you have somebody that's informed. So our next call would typically be, with the realtor, hey, because they're asking for, when you're going to submit an offer, you need to know, one, do they have money? Because they're not driving around for nothing, showing millions of properties to these people, and they can't get the money. So what we really like is encourage the telephone calls. This is what we can do. This is about how much cash they have. This is what we think they could afford, so that you're not taking them to properties that are out of their price range. Very much similar to what you do now. And then you would, if you find a property, you would put a full loan application in, and we would send out a term sheet. For those in the mortgage business, it's going to look something very similar to what's called a DO or LP sheet. DO is Fannie Mae's version of an approval, which is desktop originator. LP is loan prospector, which is a Freddie Mac's version. It's called loan prospector. And it's just very simple. It comes out and says, here's your terms, your interest rate, your projected down payment, With the documents we need from you, which is very simple: a contract of sale, proof of the earnest money deposit, their LLC docs or their corporation docs if they haven't uploaded it yet. And we're going to need insurance at some point in time. And we're ready to go. And then there'll be 2 links for them to pay for an appraisal. And then they're going to need to pay for an application deposit, which is refunded at the beginning. And that's very important to us. Let me say that, because what is one of the biggest frustrations of a realtor is running around with somebody who's not serious.
An
So
investor
we take
who
an
says, I
application.
want to, we've had the investors who say, I want to, 50 cents on the dollar, or I want to pay 20 cents on the dollar. And you go to 15
Right.
homes, rate 95 contracts, you get $1.50 at the end of the day, and that was gas money. So you're in the hole. That's not good for anybody.
And that's where, look, we are particular in who we want to lend to. All we're cared about is, are you going to make money? But in that same vein, you also have to have money to do this. So we take an application deposit, which comes out along with paying for the appraisal, which is $1,000. And that really separates the people who are reasonable and those who are not. It's refunded to them at closing. So, and we're not taking it unless the deal is, we believe it's going to work. And then from there, we order the appraisal. But in order to order the appraisal, we need your scope of work, because you're showing them a property that's typically in disrepair. They go in with that dream and say, I want to do a new bath, I want to do cabinets, I want to do everything else. And in order for us to value what the property is going to be, are you adding a bathroom? Are you finishing the basement? So our appraiser can go out and pick comparable sales that will most represent what the market value will be after those repairs are done. And here's a very key distinction for us. Tim and I have spent a lot of time over the years reviewing appraisals. I'm not a licensed appraiser, but I've seen thousands. And you need to understand that what a realtor tells you it's going to be worth, and I'm a broker, and what an appraiser appraises it for is maybe not be the same. And so our key component is making sure we pick appraisers who know the marketplace and understand our product. And they go out, they look at the property, they give us the as-is value. So let's say the sales price is $100,000. Is it worth $100,000 in its current condition? So it may or may not. We're not also concerned with the as-is value. We're concerned after the repairs are going to be done. And then they're going to say, okay, well, the more detailed a scope of work is really the key component in determining what the house is going to be. Sometimes we get a scope of work and it's written on like a cocktail napkin, new kitchen, $5,000, new flooring, $3,000. And if you're dealing in, say, a townhome community, say Elizabeth's Landing, and the appraiser is going to give it quality ratings and condition ratings, so they might just give an average rating, and that's probably all you're going to get there. But if you get into, somewhere in the Downs, and they're putting in upgraded granite and better molding, crown molding, and all these other things, we would value the property higher. Why do we get into this? So that's giving us the after repair value. We get into that because our appraisers are using the same standards that your potential buyer on the back end is going to use to get the property. And that is what has saved our bacon, is because we are really sticklers about value and making sure that the borrowers have a very clear idea of what the value is going to be when they get done, provided they do what they say they're going to do. Because sometimes they change the scope of work and it's not exactly what they said, but at least we have a basis to work with. So long-winded answer. I hope it answered it.
No, that was wonderful. And it drew me to another question that I am writing down to circle back to.
We do have a question. We do have a question
Okay.
On one of our Facebook streams.
Sure.
And it says, can you explain the benefit of using lender money as an investor who is looking to build a rental portfolio?
Lender money, is that what they said?
Yes. So can you explain the benefit of using lender money as an investor who is looking to build a rental portfolio?
So I'll answer that, and Tim may come in here. So one, if you have your own money, you aren't going to have some of the costs that are going to be associated with getting a loan. That's the one. If you don't have money, well, then you're going to need to borrow the money to get it. And I will tell you right off the bat, in all honesty, if you can qualify for a Fannie Mae or Freddie Mac product, you're going to want to take that product because it's going to be ridiculously low rates right now. But the issue is that you're going to have to comply with all of the restrictions of what they want on documentation-wise. So if you don't have a history as a landlord, you're going to need 2 years experience as a landlord to get in, unless you can qualify for the purchase of that rental property on your own income. So for example, you're making X and they look at it and they say, okay, you've got 25% to put down, maybe 30 or 35% put down, and look at all your assets, look at all your income, and will you qualify with this new purchase? And if you can, take the conventional money because it's going to be the best rates. If you don't have that 2 years experience, or you don't want to get into, as I call it, the financial proctology exam, excuse me for the visual, but you can't, well, then you need another vehicle to purchase that property. So in our world, we will qualify just on the asset and the income of the property itself. It's what's called, you told me not to get into acronyms, but it's debt service ratio, DSR. So, for example, if a property, when you go to buy the property, you'll get an appraisal. The appraisal will have a valuation of what the property is worth, and it will also have a rent schedule, which will show what the average rents are going for in the area. If that rent schedule is, say, $1,000, and you have good credit, and you have enough money down, and you have reserves, meaning it's 6 to 12 months worth of payments in the bank, you could qualify at a 1-to-1 ratio, meaning the property rents for $1,000 and your all-in mortgage payment is $1,000, then you qualify. If you don't have as good a credit, it's usually, say, a 1.2-to-1 ratio, which means your all-in mortgage payment is $1,000 and rents come in at $1,200, you would qualify. I will tell you that is a moving target right now because the marketplace for bundling and selling those long-term mortgages, because they're now 15, 20, and 30-year notes, the marketplace has dried up for a little bit. I think we won't see a lot of activity in that marketplace as far as the lending until end of May into June. So getting back to the question of why would I use lender money? Well, we have quite a few people that added a lot of properties to their investment portfolio by qualifying on just the asset, what it's worth, what it rents for, and what my payments are. And then they're making money without having to live by the guidelines that Fannie and Freddie have on them.
Hey, Rick, are the traditional banks and mortgage companies, are there still limits on the amount of or the number of investment properties that a person has?
I've been out of that realm for a little bit, but the answer is yes. I don't know whether it's 4, which is what it was down to, or back up to 10.
Wow.
But I don't know that they're back up to that. But the problem with Fannie and Freddie when they look at that is they don't want, Diane has a book of 12 investment properties. She's paying great. She walks out the door, God forbid, gets run over by a bus. Are you going under? Or you go bankrupt? So they don't like to have all that money in one basket. That's why they do it.
So that's another reason why somebody might go to you versus another bank. I had a friend who has 12 properties, and she was buying her primary residence, and as a result of that had to put twice as much down because she had a lot of money in investments. So she was viewed as a negative, as a threat, although she had equity in all of those properties. That was a higher risk tolerance to the bank, so they made her put twice as much down as a regular consumer would have.
And that's, I can't say I blame them for thinking that way, but that's the world that they live in. We don't have to live in that world.
Right.
Frankly.
Do you guys?
Because our assets are owned in a corporation. So that's another difference is, and this is a key distinction too, if you're going to use Fannie and Freddie's products, you can only have those in your name. We only do them in a corporation. which gives you more protection because you have the corporate umbrella. So that would be another reason as to why you would use a product that we would offer.
Okay.
Now, one key distinction which goes unnoticed, which is you can buy a property with us to buy, fix, and flip, change your mind and say, I want to turn it into a rental. Both Fannie Mae and Freddie Mac have a product that will allow you to refinance out of the LLC into your primary name and not treat it as a purchase, just treat it as a refinance. We do a lot of that.
I didn't know you did that. Okay.
We don't do that loan. We typically refer it out, but the product is absolutely there, which means you don't have to pay a down payment. You just, what's the property worth? What do I owe? And I'm taking it out of the LLC. I am Diane LLC. I want to turn it into Diane Donnelly owner. And you can absolutely do that.
Okay. Can I ask you a few questions in terms of your loan? And the answer may be it depends, and that's okay. Do you have a minimum loan that you're willing to lend?
Tim, I'll let you handle this because it's been a little moving target. It was typically 100 grand.
Okay, 100 grand is the minimum.
Okay. Is there a maximum?
So that is a moving target. I mean, typically we would say 2 million. We've completed larger projects than that. It seems like 2 million would probably be high end.
I think that will cover most people on the call.
Okay.
As an investment property.
Sure.
Minimum down payment. Does that depend on experience, property?
So the way we are today, this changes
Today.
It goes quickly. This is today. Now what we're seeing is we're seeing a little bit of liquidity come back to what we're doing. Like I said, a lot of the capital we've raised is additional capital. So in today's environment, you have to have experience. Minimum of we call 2 exits in the last 2 years. Bought, flipped, bought, owned. I have 2. Now, if you don't have that experience, you can partner with somebody. There are all kind of ways to make that still happen if you really want to invest. But we are looking at 25% down. Now, that's down on the project. You take your purchase price plus the amount of the renovation. Add those 2 numbers together, you need 25% of that to come to the table with, plus the closing costs. That's where we are today.
Okay.
I think, and I don't know, this is just my opinion for whatever it's worth, and that's not much, but I think by the end of May, I think we'll tend to creep up to close that gap of down payment.
So you mean that the down payment will be 30% or it would be 20%?
Well, I would hope we could get pretty quickly to a 15%.
Okay, so it's going to favor the investor.
So before, yeah, favor the investor.
Yeah, okay.
So before things tightened, when the virus hit and everybody ran for shelter, it was 10% on the purchase, and we would fund 100% of the renovation.
Okay.
Okay. We're looking for 10%. Now we've gone to 25% of the whole project. You got to bring. You'll see that number.
Mm-hmm. Well, we're seeing that in traditional mortgages too. The guidelines are all tightening up, and some of the money completely went away with like the jumbos. How hard it is to find jumbo money right now. The credit scores on FHA have gone up. Most of the mortgage companies have followed suit and gone up to 620 or 640. Some are 660. So it's not surprising that you guys are tightening it up. And I think in all your investor in the private money, people are appreciating that. How about minimum credit?
Well, Diane, if I could say, one of the big concerns with that is, and it's not only on our side, but the conventional side, is how long does this go on for? Do people have jobs, which affects their ability to repay, and or purchase, which means do the values go down? Or do they just kind of slightly go down and stay where they're at? And that's where the market is always quick to adjust to, oh my God, this, if it goes sideways, we've got to protect ourselves. And then as we get a little bit more footing and figure out, okay, we're getting out of this, there's a vaccine, or the mortality rate's not so bad, or whatever it may be, then values are stabilizing, then you're going to see that come back more into that 15% down, and maybe we get back to the 10%. But right now we're just trying to be realistic with everybody and know, you're going to need a little bit right now, and it could change prior to what's going to close. Could be more or less, and that's unfortunately our business, and the same as in the conforming side.
So let me ask you a question. Somebody finds a gem and there's equity in there. The after repair value is quite high. There's quite a bit of equity. An investor has 10% down. He's an experienced investor. Could you change and say, okay, we don't need quite that much right now on this specific deal because of the merit of the property and the amount of equity in the property? Is that something you guys consider when you're making your decisions to lend?
Today, that would not happen for us.
Okay. Yep.
We're just kind of more normalized. In a normalized market, yes.
Okay. But the risk, there's not the appetite for risk that there was 2 months ago.
Exactly. So, because we have people we answer to in the market and everything. So
Sure.
I would tell you that Rick and I value relationships very high. You come to us and you show us you can buy, renovate, fix it, sell it. I mean, we do 100%.
Mm-hmm.
We don't advertise that. We were financing all the property, but for people that we had comfort level with, that they had the expertise and the ability to do the project. So that's, to answer your question, yes, normally we put a lot of weight on that.
Okay.
Today is a little bit tricky in this environment.
Well, I think that's why you have a lot of realtors who bring business to you, because of the relationship. And when the realtors bring business to you and they bring investors to you, they know that it's going to close because they know you guys are doing your due diligence to make sure that the property and the investor are going to make it, that this is a viable transaction, because you don't want to hang on to bad debt.
Right. And even normally we shy away from new investors with no experience. But when an agent brings us to us and says, this person, I'm gonna work through it with them. I have a plan. They're gonna buy it. I know what it's gonna sell for. We have a construction team. I mean, those become easy decisions for us versus just some new investor that comes to us, like Rick said, was watching HGTV and wants to invest all of a sudden.
Right.
We take all that into account, how much they put time into putting their team together and how much value do they put. It shows us that they're thinking through this.
Yeah. So the credit score, is there a minimum credit score?
Right now it's 650.
650. Okay. And then Rick, on a couple of deals that we worked out together, there was a gentleman who did your work for you. If your investor needed somebody to go in and do the construction part of the work. Do you have somebody that says, okay, here's their scope of work, this scope of work, and this estimate makes sense, that it would,
Yes.
that it really would cost $100,000? I think I remember you doing something like that.
Right. So again, I'll go back to, this is a commercial transaction, so we're treating them like adults. They know they're going to get the work done. Okay. We have a dedicated individual, Scott Willash, who handles that for us. And he's looking at, as what they're indicating for cost-wise makes sense. Now, we're not babysitting them. If Scott says, look, the numbers look more like 10,000 and it comes in at 9,700, what are we going to care? If it is, well, I'm going to do all the work myself, so that $10,000 estimate's only 5,000, we're not going to take that. And here's why. I'll use the bus example again. You're going to do the work yourself, and that's fine. But it has to be really at marketplace rates, because if you go on the job site and break your leg, how's that work going to get done? So we're looking at just a reasonable test. We're not penny pinching and saying, well, this doesn't make, you're off by a little bit. As long as it's close, we're going to say, hey, this looks okay. And what we may do, and in times past, Tim was saying, we really look at common sense. We might finance in a contingency reserve, a little bit of extra money to make sure if you have a cost overrun, we would, have that for you to fall back on, but only to fall back on. In today's world, you have to bring that to close, or we would say, look, your estimate is way off. Because again, if it's unrealistic, it's unrealistic. And we're just trying to set you up for success. You can do it for less, no problem. You didn't use all the money, we'll just reduce your payoff. Or, you know, we'll release it to you because the job is done. Whatever you'd like to do, that's fine. But again, we want to have seasoned investors who look at this, and this is where the marketplace will be, who have a good idea what their cost is going to be. You know, and experience is you get in, you know what you're doing, getting it done. What we really like are people who have crews of workers, you know, or we have relationships with the siding guy or the plumbing guy, and that comes through experience. I mean, the other key difference with us too, between, you know, private money and hard money, is we try to pay our draws very quickly. Meaning, you know, you do it online, you request a draw, you can pre-schedule a draw, and then the wait time to get that money to reimburse your workers is a lot quicker than what other hard money lenders take to do it. And, you know, when our inspectors come out, you know, you're talking about working men and women who are hanging drywall or painting a house, and Friday has come along and rent's due, or child support or groceries or whatever. And if they don't get paid, and we're talking about the contractors and you're the person flipping the house, they may like you to the moon and back, but they're not coming back to your house, to your property, until they get paid. So they might have to go to another job site. And that's what's a deal killer for these people, is getting the people who were doing the work back in. So making sure we pay timely on our inspections and draws is another key differential or difference for us in regards to hard money. That said, the work's got to be done. So if you send us out for a draw, it has to match what you put on the scope of work, and you get paid. If it doesn't match, then how are we going to pay you for something that's not there? Because it has to be in the walls of the house to get paid.
That makes sense. Is there a minimum or a maximum term for your loan?
Tim? Term, that has changed. It used to be 9 months. We do 11 months, but now we've moved on with that because some of the concerns that we have are practical ones, which is, how am I going to get a use and occupancy rate now for a house to finalize it, to sell it, when the permit office isn't open? So we're trying to move along with being accommodating with the marketplace is. So, Tim, I think we're at 12 months. Is that correct?
Maybe 12. We can do up to 24 months comfortably. And then, you know, we do offer an extension, typically 6 months.
What are you doing right now while the offices are closed?
Well, we're trying to be unconventional, which is meaning that one of the key components that we did when this hit was we tried to touch every one of our individuals, meaning people who were flipping loans or flipping houses, is call them, where are they at, how can we help, what are your concerns? And we heard a lot of, I can't get through this because the inspectors aren't showing up here, they're not even working. And we had suggestions from other contractors who gave it to us, said, okay, we'll see if you can get a FaceTime inspection. You know, call them up. And we had some who are waiting for use and occupancies and weren't putting the houses on the market, which, as you know, as a realtor, if you're trying to get financing at the end, you can't do it unless you have use and occupancy. And again, we've seen this movie before, was just get the work done and deal with it later, because there was going to be so much downward pressure on these individuals to make these things get done. We're not saying do it wrong or do shoddy work. Get the work done, work as much as you can, get the inspections you can, and if your house is there and almost done, get it on the market. You're going to get a use and occupancy because you'll be on the phone with your delegate or your state senator saying, you're killing me. Not only did the unemployment, site crash, I can't sell this house because you guys haven't got this done. So we're in the same mindset. Everything revolves around real estate, and it's a key factor for our economy and putting the pressure on those individuals. So again, we want the work done right, but it's going to get out of the way.
Well, I think that that you are speaking from many, many years of experience. That's from, being in real estate, the mortgage side. I don't know anybody in the industry more creative than the two of you. If something needs to get done, you think outside the box to make it happen. So I appreciate that as a realtor. I appreciate that. Do you guys have any questions? Anybody on the call, or Angie, do we have any other questions?
Yeah, so there's a follow-up question from Bobby Ross. He also asked the earlier question. It says, thank you for that info. As a new investor with little to no skin in the game, at what point would you recommend creating an LLC for your portfolio? Would you focus on the quantity of properties or total value of the portfolio itself? Also, what beer are you enjoying?
Priorities.
Well, I'll go backwards. Sierra Nevada Pale Ale, always the go-to. And then in regards to not having experience right now, what I'd tell you to do is it's always good to have trusted rich uncles. So if you have someone else who is in the business or who you are mentoring with, do a joint venture. Start an LLC with them, use their capital, because I'm going to tell you, Bobby, if you don't have experience, you're not getting into this game right now, unless you go conventional, meaning Fannie Mae or Freddie Mac loan, which can do it, as I said. But if you don't have experience, and that's not going to change for a while, for the very much foreseeable future, if you don't have experience buying rental properties in our channel of business, is not going to work. So I would tell you, I can't really even answer your number of properties and things of that nature. I will tell you this: if anytime you buy an investment property, you always want protection, which would be umbrella insurance, good insurance, and making sure you have that corporate umbrella. And I would say, since you don't have that, I don't want to assume too much, find someone you can joint venture with, because that's what Tim and I can do. As you mentioned, Diane, we want to be creative. So if there is an LLC created and Bobby's uncle, Steve, has some money and has some experience, then we could work around the issue by adding them to the LLC and saying, okay, well, show us what you've done, and then we're more apt to looking at it. Hopefully that answers your question.
Okay. Ange, anything else? And then while Angie's checking that, Rick or Tim, is there anything that I didn't ask that would be important for investors to know about you or your company?
Well, I think we touched on most of it, and I think you said it too. I mean, we've done the traditional lending side, which is your takeout loan once your products are done, meaning either you're selling it to someone, what type of loans they're going to get, or turning it into a rental. Tim is an agent also. Full disclosure, we both have licenses under Keller and Flagship. We don't operate in that realm. We're on Bright all the time. Looking at comparables, making sure they look right. But the other key component is the marketing side of this equation, which is, not only when you have a buyer, you're running around showing their properties, but as a listing agent, you're looking to get the properties out there and get them sold. Right now, a key distinction for us is not only originating loans, but getting rid of the properties we have so that our borrowers can make profits and move on and buy another property and hopefully use our services. So as a listing agent right now, if you have an investment property, what's some of the biggest, the biggest impediment you have right now? Well, most people don't want to show their houses if you have them listed. They don't want somebody coming in with possibly COVID-19, touching something. The people don't want to come in because they don't know whether the family is sick, and who knows how long this will last. So all of our properties are vacant. Showing time right now, to my knowledge, will not allow overlapping showings. I think they're booked out every once an hour. You would not put this in the public comments, but the agent comments indicate the properties are vacant, they're clean, maybe put some cleaning supplies in there, hopefully people don't steal them, for hand wipes or something like that as they come through, and that property's vacant. And guess what? We have a very motivated seller because the property's vacant. So, the buyer's agent's going to read between the lines. And then the second part of that is on the marketing side, which we were doing prior to this, is there are some very strong feelings about Bright and the transition and the coming soon and all that. And we wholeheartedly agree that was kind of a, how should we say, a bad thing for a while. But on January 28th of this year, they came out with another regulation that said if the property is new construction or is having major renovations, which means no one can live in it, which is all of our properties, you can put the properties coming soon. So you're not constricted to the 21 days. So you would do that in the showing instructions, and you would indicate major renovation. And therefore, you could put out there, if they just bought the property yesterday, coming soon, for more information, contact Diane. And, our goal is to also market these properties for not only the borrowers, but for the agents as they go along, and because what we want to do is find a buyer for that house before it's even done, which is another huge distinction differentiation between us and hard money. We want the carry time on that loan to be less, which means it costs less for the borrower, which means we make less, but we're providing value to our client. The borrower is paying less money, because they're selling it quicker. The buyer or the selling agent, we're hoping gets the buy transaction, the listing, and then gets a double pop on the sale. And we have a buyer for the house before it's even done, and that's really where our focus is at. Because if we provide that value, you, the agent, are going to recommend this. The borrower is going to see that we appreciate it. They're paying less money, and they're going to come back to us. And what Tim had talked about is we are huge on relationships. Relationships is everything to us. So
that's why you're successful. It's because you provide value, so people continue to come back to you. And that was just another example of getting creative with the coming soons. So I thank you. I think the audience thanks you. And how can they get a hold of you if they have questions about financing?
Certainly. So they can go right online, which is gonavcap.com, which is gonavcap.com. They can email myself, which is Rick, R-I-C-K, at gonavcap, or Tim at gonavcap, which is T-I-M, at gonavcap. They can call the office, 443-603-0193. But everything we have is fully automated, from getting pre-approval letters to applying. We always want to talk to our people, and we always do before we fund. But the real thing is just getting online and signing up. And that's actually for, say, Bobby, who's just getting into this. Once a week, we have full-time marketing staff that sends out, we want to be useful information that is timely, that goes out, and we're not spamming you. We don't sell your information, that we, get out to our members to get them involved and ask questions and get involved. And, run scenarios by us, because that's really where, with experienced investors, it's, I want to buy 2 or 3 at a time, or I want to buy 1 at a time. And that's
business,
where we walk
right?
through the numbers to make sure it's sense.
It's right. A business. It's treated as a business.
Exactly.
Okay, well, thank you guys so much, Tim and Rick. We appreciate your time and sharing all of that information with us, and look forward to doing some more work with you, and we will be in touch.
Thank you for the opportunity. We appreciate it.
You got it. Take care, guys.